Good morning, everybody. We are live from the offices of Attract Capital, and I am with founder David Barnett.
Hi, everybody.
Hi, we are here to talk about how to pick the right lender for your business. Dave, how do you pick the right lender for your business?
Very carefully, Sonia. You want to make sure that when you're entering into a lending relationship, that it's a type of company that you can depend on for the long term. So you really want to do your homework, and you want to make sure that you're getting the right lender for your specific need for your business.
You talk about right lender. Let's say, what are the differences between a bank and a cash flow lender?
Okay, well, that's a really good question, Sonia. So a bank would be primarily an asset-based lender. They will fund a loan based upon the asset strength of your business. And a cash flow-based lender is a firm that will fund a loan based upon the cash flow potential of the business. With the cash flow lender, they usually lend you a multiple of your company's existing cash flow. So you can have very different outcomes between a bank and their credit philosophy and a cash flow lender and their credit philosophy. And it can be the difference between night and day in terms of the amount of financing that you can raise.
Oh, very, very good. So what do you think is the best option?
I think it depends on what you want to do. If you need some additional cash in your business to fund some incremental growth, then a line of credit from your bank is a very good way to go. If you're funding a long-term project, such as an acquisition, if you're really taking a big step forward, then I think you want a cash flow lender. So I think the rule of thumb is, how much money do you need? If you need a small amount of money, then a bank and a line of credit might be the perfect fit. If you need a large amount of money, then I think an acquisition loan or an acquisition loan based on the cash flow of your business is the way to go. Because typically, if you're an asset-light company, you will qualify for a larger loan based upon a cash flow approach.
Okay, and what are the differences in interest rate?
So very good question, Sonia. So the differences in the interest rate can be dramatic. So banks can charge prime, they can charge 50 basis points over prime. Cash flow lenders can be in the high single digits. So cash flow lenders can be 8%, they could be 9%. And if they're more like equity providers of capital, if they're more providing you long-term capital, let's say 5-year, no principal repayment type loan structures, they can charge 11, 12%. So there's a big difference, but the difference between the value you can get out of a long-term loan versus a short-term loan is dramatic. So paying that extra interest, in my view, is worth it because you just can't do the things you can't do the same thing with a bank loan as you can with a mezzanine loan. It's sort of like the difference between buying a Hyundai and buying a BMW.
Okay, and what about maturity rates? What are the differences, the maturity dates? I'm so sorry.
Maturity dates.
Yes.
So the difference, so that's a very good difference as a follow-up point. So the difference in maturities is quite stark. So a bank maturity for a line of credit is usually 2 years, 3 years, and it will renew at the end of the term. But a mezzanine loan, which is sort of one of the most common forms of cash flow loans, a mezzanine loan is generally 5 years where you don't have to pay back any principal. So it's quite a difference between a 3-year maturity and a 5 or even a 6-year maturity. The mezzanine loan is essentially double that.
Oh, okay, very good. So if you were to give your clients 4 things that they needed to keep in mind, what would those 4 things be?
Okay, so I have found that the price of a loan is not all that important generally to the success of a business, Sonia. What I have found is that it's how much money the lender's going to give you, because you're always going to need more money than you think to make your business successful. So the amount of the financing is point number 1. Point number 2 is the philosophy of the people that you're dealing with. Are they long-term? Are they patient? Are they understanding? If they are, you probably want to work for them. You want to look for people that are long-term and are patient and understanding. So that's number 2. Number 3 is you want to make sure that you're giving yourself enough time to repay the loan, that you're not basically setting a very difficult repayment expectation on the part of the lender. So you don't want to take a big loan and have to pay it back in 2 or 3 years. It's going to put too much stress on the business. So you want to give yourself a relaxed repayment schedule. And the third thing is that much like lenders are looking at prospective borrowers, and they're trying to get comfortable with the character of you, the business person and the business owner, you really want to look deep inside of them and try to understand their character as business people. Will they do the right thing? At the end of the day, if you're relationship oriented, and if you build a strong relationship with your bank, you get the right amount of money, you will be successful as long as you pick the right lender. So use these 4 tips, find the right lender, and get the right amount of money, and there's no doubt that you'll be successful.
Oh, thanks so much, Dave. We hope everybody enjoyed these quick tips from Attract Capital. You can visit us on the web at www.attractcapital.com. Tune in anytime on Facebook to see past webinars and past quick tips from Dave here. And we hope everybody has a great day. Thanks so much.